Tonight we're going to do deal sourcing and talk a little more about how you would go about doing that. And I'm going to be upfront with these trainings. Some of the stuff I'm going to teach you in the trainings is going to be very applicable to the case competition. And some of it is just how venture capital works. And so hopefully these trainings are informative both from a help you actually compete, but also from a learning more about what venture capital is, since that's kind of the whole goal. All right, so real quick, Brooke wanted me to just walk through the website real fast. So if you haven't been on it recently, we made a few updates. So one, just a reminder, team registration is due tonight. If you still don't have a team, or at least one other person, go ahead and register as an individual, and we will make a team. We will put you with somebody and create a team for you. So don't let you don't have a team keep you from participating. And the other thing is, if you find yourself way too busy this semester, you just don't have time to put into it, but you still want to come to these trainings, you still want to be involved, you still want to be in the email list, just join the email list here, and we'll make sure that you're included on all of those. The other thing is, how many of you were able to attend last week's training? Yeah, so not everybody, right? So that is why we are recording all of the trainings, and you can find that recording here. So if you missed last week, you want to cover some of the stuff we talked about. We did the kickoff event. We talked about what the competition is, the rules, so on and so forth, the delivery deadlines, but we also spent some time talking about what venture capital is, how venture funds are structured, all of those things. So highly, highly recommend that if you didn't come and you want to participate, that you watch that training, and that's there. And then on the website, there's lots of other questions, FAQ, et cetera, et cetera. And we will update this every week so that next week we are going to be meeting at Westminster. And we'll update the website with parking information and all those fun things as well. So as well as email it out. Awesome. Any questions on any of that? Okay. All right, so let's dive into the training today. I would like to make this as collaborative as possible, because I feel like when you're engaged, you actually retain a little bit more than if not. So really encourage lots of questions. If you have a question, just raise your hand, and I'll stop periodically. And then there will also be parts where I'll ask for your participation. So for tonight, we're going to talk about thematic deal sourcing. We're going to talk about opportunistic deal sourcing. We're going to do a little bit of a group exercise for both, actually. We're going to talk about the review deadlines and deliverables. And then what we're going to do is, for the second half, this will probably take us, 45 minutes or so. For the second hour, what we're going to do is we have some of our students, associates here. So we have Grant, Brooke, Parker. And what I'd like to do is just spend time working with each of you to start looking for deals, the source, right? So helping you think through what kind of approach you want to take, as well as what kind of deals are interesting. If you've already started hunting for deals and you want feedback on some of the companies that you found so far, we can do that. If you haven't done any of that yet and it's very early, we can help you start thinking through how you're going to approach it. So definitely have a little bit of a workshop at the end of this. All right. So with that, let's talk about thematic or opportunistic. So in venture capital and from a deal sourcing perspective, there's this concept of, are you a farmer or are you a hunter? What do you think the difference is between those two? From a deal, so you're a venture investor.
Maybe a hunter just looks for the best deal and kind of waits, and a farmer just invests in a lot of deals, looks for a lot, planting seeds, I guess.
Okay, yeah, so that's a good point. So you're planting seeds. What are those seeds? It could be making lots of investments and hoping one of them, grows. What else could it be? What else could you be planting? Who runs companies? People, right? People. So you could be planting, that planting could be symbolic of like building relationships, right? You make investments in relationships, and then hopefully those relationships will bring deals to you, right? Could be farming. And hunting, I think you did a good job explaining that. That is, you're very targeted on what you're going to invest in, and you go after that one thing. So this is pretty common. So funds typically fall in their approach within one of these two buckets in terms of their strategy, and we're going to talk about that. Typically what happens for farmers, right, is they go out and they build lots and lots of relationships with lots of different people, investors, entrepreneurs, law firms, accounting firms, all kinds of different people. And then they kind of harvest those by those people bring them deals, right? And so they're constantly meeting with entrepreneurs, and their door, as they would say, swings inward, right? People are coming in to them. Hunters take a very opposite approach, which is instead of spending a ton of time building a lot of relationships, they still have a lot of relationships because venture capital is very much a relationship game. They don't spend a lot of time meeting with entrepreneurs that come to them. Rather, they figure out a thesis, and then they go and try to find the very best company that plays in that industry to that thesis. So I'll give you an example. How many of you have heard of this firm, Sequoia? Okay, just a few of you. How many of you have heard of some of these brands? Hopefully everybody recognizes at least one of those, if not all of them. These are all deals that Sequoia backed. This is not all of them. They backed even more amazing companies, but this is just like grab a handful and throw them on the slide. So turns out Sequoia Capital is arguably the best, or one of the best venture funds out there, like period. They do tons of great investments. They've generated massive returns for their investors year after year after year. They're one of the oldest venture funds. They kind of got their start way back in the 70s. And so what approach do you think they use? You're Sequoia. You're super well known. You're really old. Everybody knows you. You have lots of relationships. What approach?
Yeah. Opportunistic.
Opportunistic.
Kind of the farmer side of it.
The farmer side, right? So it turns out that they don't, which is super interesting, right? They use more of a thematic approach. And there's actually a really famous, well, it's somewhat famous video of Don Valentine, the founder of Sequoia. And he's giving a presentation. And there's this big debate. What's more important, the entrepreneur or the market? What do you guys think? If you're going to invest in a company, how much weight should you put on? Which one should you emphasize? The entrepreneur running the company, the founder, or the market they operate in? What do you guys think? Yeah. Market. Why market?
If market's not there, I feel like no matter how good the entrepreneur is.
Okay. Anybody think differently? Yeah?
Because whoever's flagshipping the company is going to be taking the reins, and if you invest or if you feel like the entrepreneur is dynamic enough, then they can change whatever they're trying to sell to whatever market.
Yeah. So there's a concept, right? Like I'd rather invest in a grade A team with a B idea or operating in a B market than invest in an A market with a B team, right? Because ultimately they have to execute. Right? So Don Valentine is in this video, and he's actually arguing the opposite. He said, we don't back great entrepreneurs, we back great markets. And it's a little not entirely accurate, because if you look at what they actually do, is they are very focused on identifying what are the next big things, what are the next big trends, big markets, and that's where they focus. But then they go and they find the very best entrepreneur operating within that industry. So it's a little bit of both, right? But it is interesting because some funds, several that like we've worked with, and in fact we've even done this before. The entrepreneur is a rock star, and you just back the entrepreneur because you're like, they'll figure it out. They're going to build a great company. And sometimes that works, and sometimes it doesn't because the market's just not there, right? But what Sequoia has done is, even though they have tons and tons of inbound deal flow, they are very thematic in their venture investing approach. They think, they spend a lot of time thinking about what the next big trend is going to be, and then identifying kind of the best breed companies within each of those major trends and placing their bets. And they've done a really good job. Now, what's interesting about it is Sequoia then, they have this big asset, right? In the tech industry, everybody knows who Sequoia is, and everybody will take a meeting with Sequoia. So if you're Sequoia and you have this thematic approach where you've now picked the very best company, high likelihood that that company is going to call you back when you go and approach them, right? And so they use it to their advantage. All right. So let's talk about a thematic approach. This is called a Lumascape. You can check them out. It's a consulting firm. They've built a bunch of these. This can be a really helpful way to start visualizing or thinking about a thematic approach in venture investing. So this particular Lumascape is in the advertising and marketing industry. And what they've done is they basically have, in this particular case, these are agencies. So this would be like marketing and advertising agencies and what the value chain kind of looks like. But that's not all of marketing, right? It could look like this, right? So this is every piece of marketing technology and how they all fit together, right? So you've got companies that do print, you have companies that do PR, you have companies that do marketing automation, and there are a lot of those companies, right? And CRMs and e-commerce platforms and so on and so on and so forth. So what can be really helpful, or what they've done here, right, is they've got this value chain. They're saying, okay, so there's advertising and promotion, there's content and experience, there's social and relationships, commerce and sales, data and management. And there are all these different tools in each of them. And so a thematic approach could be like, hey, I think there's a real opportunity around display and programmatic advertising. And I'm going to spend my time looking at all of those companies and trying to figure out which one is going to be the number one winner. Because here's the secret about venture capital that we covered last time, is that in any given industry, the winner is going to generate most of the returns. The number two player is basically going to generate 2 to 3 times the investment. Number 3, you might get your money back. Everybody else, you'll lose money. So if you looked at this industry, and this was like a new burgeoning industry, and you're trying to pick the winner, only one of those companies is going to be a really good investment. All the rest of them, most of the rest of them, you're actually going to lose money. So you got to be really focused on trying to pick the winner. So let's do a little bit of an exercise. Give me an industry that you think 5 to 10 years from now is going to be huge. What do you think? What could it be? Yeah.
Data privacy management.
Data privacy. I like that. Okay. What other ideas do you guys have? Yeah.
Internet of Things.
Okay, IoT. What else? Anything else? Any other ideas? What's the next big thing? Yeah.
Possibly esports.
Esports. I like it. Yeah. All right. Which one do we want to do? Data privacy, IoT, or esports? Data privacy? IoT? Esports? All right. Okay. We'll do data privacy. Okay. So this is how I would approach it. We're going to build out a value chain. How many people know what a value chain is? Anybody? How about a supply chain? You guys know what a supply chain is? Okay, so a supply chain fits within a value chain. The idea behind a value chain is that every step at which value is created, right, creates that chain. Okay, so like a good example of this is like the paper you're writing on right now, right? Somebody owns some land. They then plant trees, seeds in that land. They grow trees. They harvest those trees. They turn the trees into paper pulp, right? They turn that pulp into actual paper in huge reams, and then they cut it down, and then they put it in a notebook or whatever, and then they sell it in a store, and then you go and they market and advertise that, and you go and buy it, and take it home. There's value added at every single step I just mentioned, right? So that's a value chain. So one way to look at this is let's talk about data privacy. What does the value chain look like for that industry? The data privacy is a little bit complicated or a little bit nebulous, so this is going to be a fun exercise. So at a fundamental level, what is data privacy?
I'm no expert, but I think what a lot of startups in data privacy are doing is offering software as a service where they will go and collect your company's data that may be being misused out there on the internet somewhere and assure you that it's managed and it's safe, and they provide that service for you.
Okay, so our end result here is my data is safe. Whose data? Are we going to do enterprise data or are we going to do consumer data?
Let's go with enterprise data.
Enterprise data. Okay. So the enterprise data is safe. Okay. How do we get to here? Well, first, I've got to have data, right? Of some sort. What do you guys think? What's the value chain? Get from one to the other. Yeah?
Like software production.
Okay, what do you mean?
Like software that talk about it's going to do those things. I need someone to create that.
Okay, you need some software, yeah. So we're going to assume that each step in this is some sort of software component to get to that end. Yeah?
So mining data, like where we collect the data.
You got to collect the data, right? Okay, so I have all this data. This could be like, let's come up with a more concrete example. Let's say you are Home Depot and you have a bunch of credit card information from people. Okay? People are swiping, right? So I need a way to collect the data, right? And in the data collection, do you think that there are points in which some of that data gets stolen? Yeah, there probably is, right? Like, have you guys heard about like all the card skimmers that people are putting at like gas stations and stuff? So you swipe the card, they'll actually record. So what they'll do is they'll put a little credit card reader inside where you're already swiping your card, and they'll skim the credit card information and use it for fraudulent transactions. So yeah, there could be all kinds of things, right? So you got to collect the data. So there are probably business opportunities here around secure data collection. Okay, and then what? Yeah,
Organize and analyze.
you got to organize and analyze. Perfect. Okay. What kind of opportunities do you think exist here? Maybe not being stolen, but
I think AI is a big component to that.
yeah, so maybe some sort of AI, machine learning, right? I think organizing it all by itself is probably its own bucket, right? You gotta collect it, you gotta organize it. Like there are companies that do nothing but organize data. We're an investor in one, it's called Health Catalyst. They actually do the analyzing part too, but they primarily sell the organization piece. And they sell database software to large hospital systems. Okay, so then we're going to analyze it. What are we maybe missing here? Where does the data reside? We've got to store it, right? We've got to store the data. Okay. What else? There are probably opportunities to store it in a way that's non-hackable, right? People can't hack in and steal it. What happens when my data is stolen?
Recovery.
Okay, so you got recovery. What else?
You gotta fix the problem.
You gotta fix the problem, yeah. You gotta find the problem first, right? You gotta find it, you gotta fix it. What else? Was there a hand over here? Okay. Yeah, so you gotta, and finding the problem is one, you gotta find out how they were able to get in and steal the information to begin with, right? You gotta find how it was actually stolen, right? Like, is there something broken, and then you gotta be able to fix it. And by the way, there are companies that just do each of these things. Yeah.
Also, prevention, cybersecurity. Someone who's
Okay. Yeah.
actively guarding it.
Yeah. So this could be part of store, right? So this could be
Security.
I mean, this is all kind of security, right?
Like encryption and stuff.
Yeah, it could be. We'll just put defense here, but yeah, like encryption. All right. What else? Any other parts of this value chain? So we're going to collect. We have our data here. This is our starting point. This is our endpoint that, data is protected and safe and so forth. So we have to collect the data, we have to organize the data, we have to analyze the data, we have to store the data, we have to put up firewalls and whatever kind of preventative measures we can. When the data is stolen, we need to be able to react to that. What about this could also go under store. What about accessing the data? So there's companies out there that all they do is they surf the dark web and they find places where people have posted passwords and user login information. And then they sell that data essentially to companies and say, this password with this username is out there in the dark web, so you should probably change it. Right? That's what the company does. You also have other companies like who uses password manager? Yeah, I do. You do, right? So Dashlane or LastPass or even Chrome has a built-in one, or Apple has a built-in one. All right. So hopefully, I think this is pretty good, but hopefully you can see, right? There are lots of different opportunities all around data privacy, right? And what you'll want to do is you'll want to say, okay, ideally, you would want to spend a lot of time really understanding this whole value chain, right? And all the pieces and how they fit together. And then you try to figure out, okay, where are we not doing so well as an industry, right? Where, you could look at, for example, of all these companies that keep on having their data breached and all this credit card information being hacked into and then spread across the web, why is that happening? Right? Why does that keep happening? And it could be that it's an access problem. It could be that it's a storage problem. Access, by the way, could also mean access. So a lot of the ways that these companies get hacked is that they integrate with another party. And even though Home Depot is very secure, that third party is not as secure. And so the hackers will use that as a backdoor to get in. So maybe that's where you want to spend some time, is looking at all the companies that provide protection around that, right? But either way, regardless, you'll want to pick like one of these areas and start diving in and looking at all the companies that exist within that particular part of the value chain, that vertical. and trying to figure out which ones are the most interesting, right? Who has the best team? Who has the best technology? Who has the most traction? Those kinds of things. Does that make sense? All right. I think this was a pretty good example because it's really nebulous. I think most of the stuff you guys are going to look at is going to be a little less vague. But this is how venture capitalists do it, right? They'll look at an industry, they'll say, you know what, I think the next big thing is social, or I think the next big thing is mobile, or I think the next big thing is crypto, or peer-to-peer marketplaces, or whatever it might be. And then they will go and they'll spend time looking at all the companies in that industry. And they'll do everything they can to meet with companies that get formed in that industry early, so they get a good look at everything that's coming down the pipeline. And then ultimately they make their bet. Now the other thing to keep in mind here is that we've kind of danced around this idea, but timing is a big deal, right? So data privacy is a big problem now, but at some point, right, people are going to fix all of the problems for data privacy today that we have. Now, granted, data privacy and security is like this ongoing issue. Like as soon as you like whack one mole, another mole pops up, right? People figure out how to get around your defenses, and so security is this like constant thing. But nonetheless, in terms of how they address security issues today, like eventually they'll figure out a lot of those pieces, and that opportunity will go away, right? And so you'll have to look at kind of that next thing. And so ultimately you have to place your bet, and you want to be able to make your bet and basically say, now is the right time to make the bet. If I do it too early, I'm going to fail. If I do it too late, I'm going to get outcompeted by everybody else, right? Like it wouldn't make sense to go out and launch a competitor to Uber today, right? Probably not going to win in that market, right? The same was also true back in the 90s. How many companies were there, .coms, that failed, right? Like pets.com, raised millions and millions and millions of dollars, failed. Why did they fail? Why do you guys think they failed?
Timing.
Well, what do you mean timing? What were they missing on the timing side?
It was just like congested market, probably a lot of
Yeah?
I think around that time there was a lot of bubble ideas, so you can kind of put a doc on the bubble. People just threw money at it.
Yeah, but you don't think selling pet supplies online is a good business?
There was no,
I mean, there are companies that generate billions and billions of dollars today selling pet supplies online. So clearly, it's a good idea.
maybe too fragmented.
Fragmented. They were like the only player. How many internet users do you think there were back in the 90s compared to today? Everybody's on the internet today. Back then, there were like tens of thousands of people on the internet, right? Maybe hundreds of thousands, but definitely not the millions and millions you needed. And people didn't trust the internet. They didn't trust like giving your credit card information to pets.com. So there's like two major issues: just not enough people on the internet and not enough trust. Time has solved those two issues, right? Now everybody's on the internet and we all trust it probably more than we ought to, right? And so, what's funny is if you look at the .com era companies, the ideas weren't bad. They were just kind of ahead of their time, right? Because if you fast forward to today, a lot of them are multi-billion-dollar successes. That same idea. All right, so we want to make sure that we have our timing down. All right, so the next approach is an opportunistic approach. So this is just generally like you're just looking for great deals rather than looking for the best deal in any specific industry. Like I mentioned earlier, it's typically very oranges, like all deals are fruit, but like there are returns to specialization, basically, right? So a lot about consumer products, you probably want to focus on consumer products. If you know enterprise software really well, you probably want to spend your focus on enterprise software and not try to do everything as an investor. ultimately, what this approach is going to look like for you guys, if you want to go this route, is you're just going to start surfing and like lots of websites and just looking at deal after deal after deal after deal. I don't know that one is going to save you much more time than the other, frankly, because in this approach and a thematic approach, you have to spend a lot of time really getting smart about an industry, right? That's where you're going to spend the bulk of your time. On an opportunistic approach, you're going to be looking through lots and lots and lots of deals. And as you look at more and more deals, you'll get a better feel for like what's a more interesting deal and a less interesting deal. And by the way, both approaches can work very well for funds. So any questions on those two approaches? Okay, so you've picked your approach, and now you're in the phase of like, okay, now I need to start narrowing it down, right? How do I tell if it's a good company? So, one, you want to look for companies that have a unique product or business model, something that gives them like a competitive edge or a competitive advantage. So a unique product, when you guys are looking at companies, that could be they have some sort of technology that gives them a huge advantage over their peers, right? They have and that can be driven by a few different things, right? So last training I talked about this one company called Quanergy that has, they basically spent years and years and years in the lab and tons of money building this LiDAR product that can fit in the size of a pack of cards, and whereas the current standard today is this giant contraption that spins, right? So they have like a zillion patents around it. So that could be something, right? Those patents kind of give them some protection from other people copying their technology. It could also be from the team that they've built and the underlying technology that team has built. So a good example of that is our investment in Fastly. Fastly is a content delivery network. Anybody know what a content delivery network is? No? All right, it's really boring, but you all use it all the time. You just don't know it. So the way the internet works is when you type in like a browser, an address into your browser, right? Like let's say Spotify.com. Your computer is sending a signal off to the Spotify server and saying, hey, send me all of the code, basically, for Spotify, right? So then they'll send that over the internet to your browser, and your browser, what it does is it renders that code into a website or into an application, okay? Well, that time it takes to go from here, like if I were to pull up Spotify is headquartered in Sweden. That's really far away, and even at the speed of light, like that takes a long, assuming that I have fiber, right? It takes a long time to get all the way over there and a long time to get all the way back. And we're, as humans, not very good about waiting, even for like a couple seconds. And so oftentimes what happens if the website doesn't pull up immediately, what do?
Fresh.
You refresh if you really want to go to that website, and if not, you leave, right? You go somewhere else. So what a content delivery network does is they basically move the server, the computer that your computer is talking to, closer to you, ultimately. And so I don't have to go to Sweden to get that information. Maybe I go to the server farm in Salt Lake and get it back. So that's what a content delivery network does. Fastly, what they do is they have gone out and they have built this culture around, we are going to build really, really great technology. And we're going to attract the very best technologists that want to solve really hard problems. And then what they did is they built this content delivery network wherein instead of having your computer or the server way back home do all the processing work, they do the processing work at the server closest to your computer. So a good example of this is when you go to Airbnb and you open it up on your phone or you open it up on your computer, the pictures are automatically scaled exactly for your size of screen, whatever you've got. And they don't have a whole bunch of pictures all at different size resolutions. They automatically scale it every time you demand that picture. So they can only store one picture on their servers. Right? So that's an easy example of what they do, but really, really hard technical problem to solve. Really hard for another competitor to replicate that. So that could be an example. They don't really have any, they have patents, but the patents aren't really protecting them. It's more like all of this kind of industry know-how and having a really great team and so on and so forth. So that was a long explanation, but hopefully you guys learned something new about how your computers work and how the internet works. The last could be a really interesting business model. So Amazon's a classic example of this, right? They cut out all the middlemen, right? That at the time was a pretty innovative business model. Uber and Lyft are pretty innovative business models, right? We're going to use peer-to-peer to provide these services on demand. And we're going to unlock all of this value that's just sitting there otherwise, right? Like your car just sits there most of the time. You spend all this money on that car and it just sits there, right? Well, Uber allows that car's value to be more fully unlocked, right? By getting it used more often. To the point where you don't really need to have a car, right? So you could have a business model if you're comparing Uber to taxis that gives Uber like a huge advantage. And the other thing that's interesting about Uber is you get these really interesting network effects, right? So the two drivers, what are the two drivers behind like Uber's growth and success? What do you think? What feeds on each other? Creates a virtuous cycle. Yeah.
You get a lot of people that want to become a driver
Yeah.
to make money, as well as people that want to use the service to get around.
Yeah, so maybe you guys don't remember this, but when Uber first launched, how long do you think you had to wait for a car to come get you compared to today? Today it's probably like 5 to 10 minutes. Back then it could be like 20 to 30 minutes sometimes, right? So then, but what happens is you attract more drivers onto the platform, that wait time goes down. As the wait time goes down, more passengers want to use it, right? Which means now there are more passengers, so more drivers can make more money, so they want to get on. And as more drivers get on, it further reduces the wait time, right? So it creates this like virtuous cycle, right? And then as other companies come in and try to compete, they don't have both sides of that marketplace. And so it's really hard for them to provide the lower wait times, right, that Uber already has, right? So that business model creates kind of these really interesting like virtuous cycle and network effects that make it really hard to compete against them. Now, the flip side is it's really hard to get started, right? It's a little bit chicken and the egg. You got to get the passengers when you don't have drivers, and you got to get the drivers when you don't have passengers. And ultimately, you know how they solve that? A lot of money. That's right. Solving lots of money. There's an argument out there that the only competitive advantage that really matters in the long run is network effects, though, because pretty much everything else you can eventually erode away, right? If I have amazing patents, eventually those patents expire, right? But once people use a product, it's really hard to displace them, right? This is why we all continue to use Instagram and Facebook, even though Facebook has major data privacy issues, because we're all on Facebook and Instagram, right? And so that's where everybody is. So it's really hard for another competing social market or social media company to take off. All right, so you want to look for that, right? You want to figure out like what do they have that's really truly unique that sets them apart from everybody else. The next thing you want to look at is, do they operate in a big market? How big of a market do you think they have to operate in to be interesting?
$1
$1
billion.
billion? Why $1 billion?
Sounds like a big number to me.
Sounds like a big number.
Depends on their market leadership, right? Or their market share.
Okay.
They control market.
Depends on how competitive the market is. Yeah, definitely. Yeah.
Let's say there's like a service chain market.
Uh-huh.
It's the bigger picture. And within that, the bigger the service and the market, the smaller service you can
Okay. So how big of a market then?
Well, that's why billing is so good because if you get any problem, let's say healthcare,
Yeah.
that's 20% of the GDP, but that's just to serve the market for sell the product.
Sure.
So we can focus on cardiology, we can focus on the neurology, like those are very specific parts. 10 billion to 100 billion, that you get small products that get small too. The bigger the circle, the smaller the
Sure. Yep. Definitely. So yeah. So if you start out with hopefully bigger than $1 billion, healthcare is bigger than $1 billion.
Yeah.
But if you can work your way down, and that subsection is still $1 billion, that's probably pretty interesting. All right. So let's do some quick math. So let's say I have $100 million venture fund. Okay. And what we talked about last time is that basically, if I make 10 investments into companies, I need one of them to generate enough return that it will, just that one deal will return my entire fund. So if I invest $10 million per company, right? Per company, then that company needs to be worth $100 million. Well, my stake in that company needs to be worth $100 million, right? In order to return that fund. Okay. So how much of the company do you think I end up owning by the time this company gets acquired or goes public with a $10 million investment?
60%, 40%.
Yeah, so let's say I own 25%, or let's say I own 10%. We have two numbers to work with, give us a little bit of a range. And these are fairly typical of what venture funds will ultimately end up owning of a company over its lifetime. All right, so if I end up owning 25%, that means the value of the company when it gets acquired or goes public has to be how much? 400 million, right? Simple math, right? I invested 10 million, I own a quarter, I need that 10 million to turn into 100 million, which means I need a quarter of 400 million, right? And for 10%, $1 billion, okay? What kind of revenue do you think I need to generate in order to be worth $400 million?
Depends on the multiple, but it's 10x and you use 40 million.
Okay, so we can assume, let's say 10x revenue multiple, which is aggressive, I would argue, right? Most companies are probably valued closer to like 3x on average. But if you have a really hot startup and it's growing fast and it's enterprise software with like 80% gross margins and they're just crushing it, yeah, you could get 10% or 10x your revenue. So it's revenue times 10. So they got to be doing 40 million in revenue. Okay, $1 billion at 10x. You'll be doing 100 million in revenue. Okay, so let's go back to our market example. If I have $1 billion market, they have 10% market share. That's not crazy for a company to achieve 10% market share. That make sense? That's why $1 billion is usually the number that people talk about. It's got to be worth at least $1 billion. Now, I will also say, VCs hate it when entrepreneurs are like, if we just get 1% of the market, we will be like this big. Because it doesn't take into account how hard it is to get to even 1% market share. Right? What's more useful is actually looking at like, how much does it cost for you to acquire one customer? Right? And then let's how many customers are there, and let's multiply that out. And pretty soon you find out that it's really hard to achieve even 1% market share. But if you're a market leader and you're growing fast, at the time where you get acquired and you go public, this is what you're hoping for, is that the company is wildly successful and able to capture about 10% market share. That makes sense? So that's what we're looking for. Question though. What if like your market doesn't exist yet? Airbnb, when they launched, right, they got turned down by so many venture capitalists because they were like, I don't think people are gonna want to like pay money to sleep on somebody's couch, a stranger's couch, right? I just don't know. That seems like a really small market. Nobody does that today, right? At the time. Was it a small market though? What was the market size for it?
It's hospitality.
It's hospitality, right? It's at least hotels. Arguably, it's bigger than hotels, right? Because all of a sudden you reduce the price of travel, and so that increased the number of people that can go and travel, right? So it probably actually is a bigger opportunity than hotels in terms of just number of people. So that's what you're looking for. You're looking for how big of a need does it solve, right? And is it solving $1 billion pain point at the end of the day? Or another way to think about this is, would people be willing to spend $1 billion to solve this pain point, right? Collectively. All right. The last one is like a killer team. And keep in mind, like, we're going to cover a lot of more like deeper levels of diligence that we're going to do in other sessions. These three things are just, you're just trying to get through as many deals and check boxes, right? Does this have something unique and special about it? Yes or no? If the answer is no, maybe you can probably move on, right? If they are operating in a big market, right? Great, we're going to do it. And they have got a compelling product or unique product, great. If they don't have one of those two, then maybe you kill it. And then the same thing, do they have a killer team? So what I look for is, do they have people that are really experienced, right? I mentioned this last time. I really like entrepreneurs that have been in the industry. They felt the pain point personally. They understand the pain point at a very like deep and fundamental level. And they have tons of connections in the industry. They know exactly how to sell into it. They know exactly who the players are and the companies that have the pain that fill that pain point, et cetera, et cetera. Like, those are great. You also look for people that are really passionate about what they do. So if you think about like Mark Zuckerberg, do you think Mark Zuckerberg shows up to the office every day because he wants to make more money? Probably not, right? The thing that's really interesting is like money definitely is a huge motivator, but most entrepreneurs are not driven by the money as much as they are about like making a dent in the world, right? They're very passionate about having an impact. And solving whatever the pain point might be. And so that's the kind of entrepreneur you're looking for. Frankly, most entrepreneurs are a little crazy because you kind of have to be a little crazy, right? In order to go against all the odds and say you should just get a normal like job. And then the last thing is this idea that they call team market fit. So does your team fit the market? So more than just like the one entrepreneur or the founder, have they built a team around them that fits what they have to go out and do, right? So if I'm a fintech company, I probably need a chief risk officer that's been there and done that, right? If I'm a consumer products company, does it matter like how like wonderful and effective my product is? Yeah, it probably matters a little bit. What matters more? My ability to sell that product, right? We've looked at a lot of companies over the years where it's like, wow, that's a really cool product, but you do not have the team to sell that product. And there's other products that are a lot crappier, but they have just an amazing sales team or marketing team that know how to sell it, and they're going to end up winning that market. Really good example of this is GoPro. Who thinks a GoPro looks cool when you strap it onto your forehead? I mean, it's like you're like bolting a like toaster to your forehead, right? Like, we're really not that cool. There was another company that we almost invested in called Contour, and it was this like really cool thing you bolted to the side, and it had like switches and lasers to like make sure everything was level, and they like pioneered like putting it on your phone so you could see the screen, you know, what you were seeing through the camera on your phone before GoPro did. It was like really cool tech, waterproof right out of the box. You didn't have to put it in another like plastic case. Who do you think was a better marketer? GoPro. GoPro is an amazing marketing company. Right? At the end of the day, like they're a marketing company that happens to sell an action camera, not the other way around, right? And this other company was the other way around. They had an amazing action camera, not so great at marketing. And so ultimately we passed on them, and eventually they went out of business. So do you have the right team that can actually execute against what you have to do? And part of that is understanding like what does it take to be successful in this industry, right? All right. I'm going to stop there. What questions do you guys have? Any questions? Feedback, pushback? All right. So those are the three things that I would suggest you look for. Yeah.
Is there one of these that you think like has more impact on whether a company is a successful company or not, or like one of these 3 points?
I kind of approach them in this order. So it's like, do you have anything special or not? Okay, you have something special. How big is the market? Okay, market's big enough. Okay, do you actually have a team that can execute against it or not? Right? If you do, wow, you've got all 3. That's pretty interesting. Let's spend some time on this. Okay. Yeah.
Is there a sweet spot of team members that you look for?
No. I mean, it just depends. The only thing that I'll say is that you don't want them to be too big relative to their traction. So there's a saying that premature scaling is the #1 cause of death for startups. In that they think they've found their product market fit and they start hiring too aggressively, and it turns out they didn't really find their product market fit, and the whole company collapses because they hired too many people. Right? Started spending money too quickly. Yeah.
Been looking at like a lot of deals and potential investments, and what's an easy way? Like, I know what you're looking for, but is there an easy way also to like look for? Okay, this is a no. Sometimes I just get reading about a deal and it's interesting.
Yeah.
But it's hard to know, okay, put that one side move on.
Well, yeah, and that's what I'm hoping, like through these 3 things, you can those are your checks, right? Looking at like, it's kind of interesting, but do they have anything special, right? Relative to what somebody else could put together. Yes or no, right? If they do, check, yes, right? Go on to the next thing, which is, do they operate in a big market, right? Is it big enough, right? Yes or no. If it's a no, kill it, right? Move on to the next deal. But if it's a yes, check the yes box and then look at the team, right? Then ultimately, you guys are going to you're going to find, hopefully you find a bunch of deals that check all 3 boxes. You'll be surprised how many do not check all 3 boxes, which in a way is like kind of sad for entrepreneurs, right? 'Cause it's like they're spending a lot of their time and energy towards something that probably won't be successful. But then once you've kind of narrowed it down, you've got a whole bunch of companies that check all 3 of these boxes. Then it's like weighting one against the other. Like, how does this team compare to that team? Or how does this competitive advantage compare to that one? Or frankly, like, which one do you just find more interesting, right? You're more excited about. And those are all like totally valid reasons. Any other questions? Yeah.
The market also not only have to be big, but also expanding. You just kind of have a pretty stable market and it kind of stays at around, let's say 10 billion. It just kind of stays there and operating there, or does the market need to be continually growing?
So the challenge with your question is I believe that like the fundamental needs that people have never change, right? It's just the way that we solve those problems. So if you think about it from a perspective of like, what's my pain point? Pain point's going to grow at the same rate as like population ultimately, right? But the different ways in which we solve that pain point could be considered markets as well. And so ultimately what you do want is you probably don't want to invest in a market that's too stable. You want to be investing in a market that's growing, right? But like my Airbnb example, right? Like if you look at that market, it's super teeny but growing insanely fast, right? In terms of people renting out their space within their homes to other people, right? But if you were to just look at the like fundamental human need of like I need shelter, right? That probably hasn't changed much, right? So
Probably all of it's like their overall market, how many people, but also like how well your company, like Airbnb, for instance, hospitality is a big industry, but it's different than Airbnb's market. Airbnb's market is how well they're doing, like reaching more people to stay at their houses. Like
yeah, I mean Airbnb is kind of an extreme example because like their market of peer-to-peer, shelter essentially like didn't exist in a meaningful way, right? Before they came around. But hospitality overall as an industry is growing, right? People like to travel. So
What about a market like, just throw an example, electric car charging stations? Right, so it's something that we see a future of can grow expansively, but right now it's not very large. Where do you value, or like how do you go about analyzing a market that's something that's probably going to go a lot, but it's not really here?
yeah, well, what do you think? How would you approach it? What are your parallels?
I don't know, I think you just have to draw assumptions, say, okay, by this point, we're going to have this many cars that are electric, this many cars that are electric, you're going to need X amount of car charging stations. And I think finding reliable sources to be able to make those assumptions from. But
how many people are buying cars?
Yeah.
and what the trend has been over the last 5 years, is that continue to grow more?
Yeah, I mean, you got to kind of look at like what are all the trends hitting that, right? So one trend could be, the easy parallel is gas, right? How many gas stations are there, right? We're gonna need to be like some equivalent gas stations as there are electric stations, except for you have to take into consideration that everybody's home is now a gas station, right? So I drive an electric car. I never, like today was the first time in, I don't know, at least 6 months that I actually plugged it into a charging station. Because usually I just plug it in at home. But you have different trends, right? So that's a trend, right? The other trend you have is that maybe car ownership is going away, right? So you have Uber and Lyft that make it more economically feasible, especially if you live in a city, to just do full Uber, full Lyft. But you also have a number of companies that are now leasing a car to people, right? So, I mean, it can kind of impact car ownership in a lot of different ways. So you'd want to look at kind of all those trends. But yeah, ultimately, you're just trying to guess that, right? I think with electric charging stations, you're probably not too early to invest in something like that. If anything, you might be a little bit too late because there are a lot of companies that have raised a ton of money to go after that opportunity, right? Any other questions? All right, cool. We're good on time. Oh, we're a little over. All right. So other things that you can look for in potential deals to help you narrow it down. Can it scale super fast? So this would be like software, right? Like I write software once. It doesn't cost me anything more for each additional person that uses that software, right? Maybe a little bit of server space or a little bit of server cost is all. So these things can scale really fast versus services, right? Like if my business is giving haircuts, like I gotta hire somebody else in order to do more haircuts, right? I can't just magically make them happen with just one stylist. Operates in a huge potential market. We talked a lot about that, but just this idea that it's potential, even if it might be small to Uber and Lyft, and that it can create liquidity in the next 5 to 10 years. In other words, something about the company is compelling enough that somebody will buy it, or they could be a standalone business and go public and grow and continue to grow over the long run. All right, so some things related to the competition. We're going to pretend that you don't have a $50 million fund. We're we're going to pretend that you guys are seed investors at a seed fund. And because of that, we're going to assume that your fund size is $50 million. So that you are in year one of a 10-year fund. So the way these funds work is investors go to the entrepreneur and they say, I will commit for the next 10 years to invest $50 million with you. And then those the venture capitalists go out, they find deals, they call up the investor and say, hey, you know how you promised that $50 million? Well, I need $1 million of it so I can give it to this company. Okay? So they last for 10 years. And then by the end of that 10 years, the investors are hoping that that company goes public or something. And I take all the money I generated from that and I give it back to them. So you guys are in the very first year of your fund. Okay? And you are targeting to do somewhere between 30 and 50 deals. Because for a seed stage fund, you're not going to invest $10 million per deal. That would only be 5 deals. You're going to invest a lot less. You might invest like $500,000 to $1 million in that company over its lifetime. And so you need a much bigger return than just 10x. You probably need to be somewhere in the like 50x range. But what I'm going to let you guys figure out in your own presentation is how much should you invest in that company that you find? What should your ownership targets be, and how much should you reserve? Or in other words, how much capital should you, once you've made the investment, how much should you hold in reserve to put into the company as they continue to grow so that you don't get diluted? We're going to talk about these things a little bit more, but I just bring them up because like this is the scenario, right? Competition is you are all venture partners. You are finding, your job as a venture partner at this fund is to go out and find a deal, right? That's what you're getting paid the big bucks for. And then you're going to diligence that deal, and then you're going to come to your partners and you're going to pitch the deal and try to convince your business partners, the other venture capitalists at your firm, that collectively as a fund you should make that investment. That's the whole premise of this competition, right? So that pitch is going to happen December 4th, and the top 5 teams that have identified the most compelling opportunities and done the best due diligence will be the ones to actually make that pitch to our panel of venture capitalists. So this is the fund that you're working for. Does that make sense? Any questions? I know I covered a lot right there, so if you have questions, feel free to ask. Yeah.
So only companies that are in the seed stages are eligible for us to choose for this. If someone has already gotten the seed round and they're a little bit farther on in the process.
You can go a little bit further on. That's okay.
We can still.
Yep. That's fine. But like if the company's generating like 50 million in revenue, it's probably a little too far along. Because you're not going to get the return you need. And you can't write a big enough check. Right? Yeah.
So they've had a Series A that's anywhere between say 8 and 16 million.
Yeah.
But that's out of our realm since we only have 50 million and we're looking to do 30, 50 early stage deals.
If they've closed a Series A, that's probably tough. But you could participate in a Series A.
Okay.
Unless, of course, you think like, hey, the Series B, I could still get like 50 times my investment, which, by the way, can totally happen, right? Like, if you invested in Facebook Series B, you would have made something like 1,000 times your investment. So, I mean, which kind of depends again back to that market share question, right? Yeah.
Is there going to be a workshop on the memo portion?
Yep.
Okay.
Yeah, so tonight we were just covering like deal screen stuff, like deal sourcing, you know, going out and find deals. How do I find deals, and how do I kind of go through a very quick selection process to identify the good ones? The next trainings we're going to spend, the next 2 trainings, we're going to spend all of that on actually doing due diligence on the company that you select. Do you have a question? Any other questions? All right. So I threw this up last time. I'm just throwing it up again. There's a lot of good places you can go to find deals. I don't remember if this one was up here, but if you want, you can totally invest in an ICO. Who knows what an ICO is? They're kind of out of favor. They were super hot about a year ago. So an ICO is called an initial coin offering. It's a cryptocurrency way to invest in companies. The idea behind it is these companies would issue their own coin, like Bitcoin, and people could buy that coin, and then they would basically, through that coin, own a percentage of either the company or the future revenues or profits of the company, which is effectively the same thing. And you had a lot of top-tier venture funds that were actually participating in these ICOs. So like there was a company called Filecoin that had participation from Sequoia and Andreessen and a bunch of others. And there's a bunch out there. So it can be, and I just throw it out there because you can get a lot of information on companies. The downside is that they are insanely risky and getting more and more regulated. So
Would Libra have done an ICO?
Libra is kind of sort of doing an ICO. So what they're doing, right, and there are venture funds investing in this. They're saying, you give us $10 million, we'll make you one of the founders, and then you will get so many Libra and some control over, the future of the coin. So it is a type of ICO. Any other questions? So basically, all of these sites operate under basically the Crowdfunding Act, which enables individuals to invest in startup companies and privately held companies without having to be a high net worth individual. And so because of that, a lot of them have a lot of information about their company that's out there.
So I've actually gone through some of the websites, and a lot of them are asking me if I am an accredited investor or not. And I always say no, obviously. I'm not rich. But it's like, so it's not really doing the exact thing you're talking about.
Yeah, some of them like AngelList, that's probably the case. Yeah. But some of them like Start Engine, Fundable, Crowdfunder, you don't have to be accredited for those.
Same thing on AngelList. It was like they asked me for a company or organization email, so they wouldn't accept my Gmail. They wouldn't accept me. I was like, come on.
Yeah, AngelList can be a little tricky to get into, but yeah. And if you know somebody that has an AngelList account, is willing to let you dig into it. All right. Any other questions?
You mentioned last week that was you find reliable financial information. So I was going to ask two questions. One, what specific numbers are we going to need? And two, I was digging through some of these websites. Some of them it didn't look like had it on there. For most of these, are we going to have to dig other places to find that information?
Some places you can dig a little bit and find other information. Hopefully, a lot of them will have something. You don't have to have a full set of financials. I think having anything kind of around current revenue would be helpful, or how they haven't launched their product and started generating revenue. What's the business model? How much are they going to charge? What's their pricing? Et cetera, et cetera. And then, the onus will be on you to be able to say I think these are reasonable expenses that they're going to incur and build out those financials. Yeah, I'm under no illusion that finding deals is going to be a little tricky. That's actually kind of the point of this, is that in the real world as a venture capitalist, finding really good deals is kind of tricky. But that's what it actually is like, right? And so here's the thing I talked about last time too. Here's one of the big secrets about venture capital. If you can find really great investment opportunities, you can find the next Facebook kind of thing, right? The next Google, the next Uber. That's kind of all it takes, right? You have to be able to you have to find the deal. You have to be able to convince the entrepreneur to take your money. But if you can do those things, you can be successful. I'll just end with an example of it. guy named Chris Sacca. Anybody know who Chris Sacca is? He is by far the most successful angel investor ever. He's like the seed. He is a multi-billionaire today based on the seed investments he made as an individual, as an angel. He was a seed investor in Twitter, a seed investor in Uber, and a couple other companies. But what's interesting is at the time, he was like at Google, he had like an okay job, but he believed very, very strongly that Twitter was going to be a huge company. And he basically went in and he invested all of his own personal money that he scrounged together. And then he went and convinced his friends to like invest with him into the company. And then ultimately, before Twitter ended up going public, he went, I think it was with Goldman Sachs or JP Morgan, one of the two. He went to them and convinced them to do what's called a special purpose vehicle, where he raised like, I think over $100 million to invest in Twitter. And then he took a cut of the profits off of that, right? Like he just made it happen. He wasn't super rich at the time. He was just super scrappy and figured out how to get in and make it happen. And that happens it doesn't happen a lot because a lot of people are willing to put in the work and effort and take the risk, but it does happen in the industry. So, all right, just a reminder, next week is the workshop number 3. We're going to start tackling due diligence. That'll be at Westminster. Just a reminder that your team signups are due tonight. So if you haven't signed up your team already, go and do that. Again, even if you don't have a team, just sign up yourself individually. We'll get you a team member, a teammate. And then next week, your 3 companies are due. So basically, you need to spend this week searching for your companies, narrow them down to 3 that you think are interesting, and we'll have an online form, and you'll just go in, you put the name of the company, probably like some sort of link back to them, whether it's their website or if they have a profile on one of those prior sites, and then a quick description of the company. So you'll do 3 of those and submit it. Should be pretty simple. You're not 100% locked into doing one of those 3, but we have you do 3 because when you're doing your diligence, you might find something that's a total deal killer, and you don't want to have to restart your whole deal search over again, right? You want to just go to the next one down the list. And then you'll have basically a couple weeks to start doing your due diligence and picking one of those 3. And then we'll have our event down at UVU. And then you'll have basically a few more days to wrap up all of your due diligence and submit it. And from there, we'll select the companies, the top 5. And those top 5 we're going to pair with mentors. So they have a little bit of time to prepare their presentation, get ready for the final day. So, yeah. So those are the assignments, things to think about. Any other questions?
Hey, Peter.
Yeah.
It's at 6, not 5.
It's at 6, not at 5. Right. 6 to 8. Rick. All right, well, thanks everyone for coming.